This morning on the Ag Issues program, a pleasure as always to bring to the program Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thanks.
Well, I appreciate you coming on to the program. Now, you are in Nashville today and tomorrow, but specifically, you're going to be presenting to and the NCBA's annual convention and trade show taking place in Nashville starting here later today. You are going to be presenting to the NCBA Tax Committee coming up later this afternoon on the practicality of the One Big Beautiful Bill Act, that is, and their provisions for livestock producers.
Yeah, that's right. And there's a lot of things, of course, in the One Big Beautiful Bill that apply to livestock producers. Some, of course, generally to farmers and then also ranchers. But there are some that are specific to livestock producers, and that's what we'll be talking about this afternoon, plus give them an update on where we're at on some of the hobby loss cases and some of the challenges there and what farmers and ranchers need to be doing to not get caught up in those rules.
Well, let's first start with some of those provisions in OBBBA for livestock producers. Let's start with capital investment and accelerated cost recovery.
Yeah, this is a big deal. And Greg, I think people also need to think about what the landscape would have been had this bill not passed. And, of course, everybody up and down the taxable income range, other than the very bottom end, would have had a significant tax increase. Bracket rates for the 12% bracket range, which married filing joints, basically 25,000 to 95,000 taxable income. You'd have seen a 25% rate bracket increase without this bill. And one of these other things, of course, that if the bill hadn't passed, we wouldn't have got restored 100% bonus depreciation. But now that's been permanently restored for qualified property. So that's your machinery, that's your grain bins, that's your certain single-purpose structure, that's going to be your breeding livestock. In fact, I wrote a piece a couple of months ago on how bonus depreciation could be used to help rebuild the heifer herd, and that made it to a hearing on Capitol Hill. That's a really big deal. So that's an immediate deduction of the full purchase price, which can drop your income in high revenue years. And then, of course, it took Section 179, the off-the-top depreciation allowance, and it basically doubled it. And so that went up to $2.5 million last year. It's a little bit more with an inflation adjustment this year. And that one, sometimes farmers and ranchers get confused as to what the distinctions are between those two. But think of basically bonus depreciation as a bulldozer and Section 179 as a surgical knife. And we really like to use Section 179 in farming and ranching to target specific assets while you save your standard maker's depreciation for others. So that gives us that approach that we can use to fine-tune the management of our tax brackets that bonus depreciation doesn't offer, because it applies to entire asset classes. And so those are the big ones on the depreciation side.
Well, going through, like you said, there are plenty of things to discuss. Another big one that I know that producers are going to like is permanent pass-through optimization.
Yeah, this is what I'm talking about here is this the renewal of the 20% QBI deduction on your farm income. So if you're not in a C corporation, you can take a 20% qualified business income deduction off of your business income. So, for example, if I've got $300,000 of business income, farm income, income from my farm or ranch, I get a $60,000 deduction. So it's 20% of $30,000. So, if I'm in let's just round it off a 33% tax bracket. That lowers my tax liability by $20,000. That would have gone to zero without this bill. And I reviewed a return about this time last year for a CPA in Kansas for a farmer and ranching operation kind of in central western Kansas. And that deduction was over $600,000. And based on the tax rate that taxpayer was in, that's a $200,000 reduction in tax liability that would have been a zero reduction in tax liability this year. So you want to think about struggling farmers and cash flow. Without this bill, would have been a tremendous disaster for small businesses and agriculture and taxpayers in general. So that's a big one too. The maintenance of that QBI deduction, keeping it in law and making it permanent.
OBBBA also addressed the death tax and really looking at the preservation of generational wealth.
Yeah, we got a $15 million exemption, and that's been made permanent. It'll adjust for inflation starting in 2027. And, Greg, if we go back to the fall 24 election, had that election come out a different way and the control of House and the Senate had been different in the White House, we could be talking today about a $3.5 million exemption with only $1 million basis step up. That would have been an absolute game changer for agriculture. But now we're at 15 million. It's the highest it's ever been. Step up in basis, full step up in basis for assets, including the estate, was retained, and portability of the unused exclusion at the death of the first spouse. So we're really in a sweet spot. Never been better with respect to federal estate and gift tax.
Moving on, as far as other provisions are concerned, also looking at specialized agricultural liquidity tools as well.
Yeah, we got two of these here. New Section 1062, which I was the primary drafter of. It was Senator McConnell's office that called back in June and wanted me to write a provision that would allow the complete 100% exclusion of gain when a farmer sells farmland to another farmer, and it's going to be used in farming for 10 years. Now, it didn't come out that way. It's not an exclusion of gain, but what it is, in the legislative process, these things change, and what it came out is if I'm a farmer and I sell my farmland to another farmer, and it's subject to a deed restriction requiring that buyer to use it in farm use for 10 years, then I get to spread my gain out over 4 years equally. So I get all my money up front. It's not like an installment sale where if I sell my land, say on a 15-year installment sale, I get a piece of the income back every year. Here I get all of my income from the sale in year one, and then I can report the gain. I can spread that out over 4 installments, basically. I report a fourth of it with the return of the year sale, and then the next 3 years equally over those 3 years. So if you're exiting the farming business, you can do that with full liquidity while avoiding a massive single-year tax spike that would push you perhaps into a higher capital gain bracket. That's the point of that one. And then another one is primarily for banks that lend to farmers, and farmland is used to secure the loan. The banker can exclude 25% of the interest income earned on those loans. So that's lender specific. The idea here is to incentivize lenders on these types of loans to drop the interest rate because they're getting a tax break. I'm not sure that it's enough of an incentive to do that. It may move it by maybe 0.2 of a basis point, but nevertheless, rural banks on these types of loans will see a tax break.
Another part of this, before we go to break, is risk management and compliance relief.
Yeah, the bill maintained the ability to defer crop insurance proceeds to the following year if you have your normal business practice is to defer the income from your crop sales. And there were some livestock-related disaster provisions that were enhanced in OBBBA, and those are the big ones with respect to risk management and compliance relief.
Roger McEowen, professor of agricultural law and taxation, is our guest, talking about some of the practicalities of the One Big Beautiful Act provisions for livestock producers, and we've been going through several of them. As we continue, Roger, one of the things as well, and people will know this acronym, concerns the salt cap.
Yeah, this is the deduction for state and local taxes, and OBBBA temporarily increases it to $40,000 for 2025. So on the returns that are being prepared right now, that goes to $40,000. But it has an income phase out on it. So as your income goes up, your deduction goes down. But the deduction can never go below $10,000. And this is there just for a few years, and then it'll crash back down to $10,000 unless Congress reauthorizes it at the $40,000. So $40,000 on the current year returns that with a phase out, but it can never go below 10.
All right, let's go on or move on. Also, strategic opportunities for livestock producers in the OBBBA commodity title.
Yeah, a lot of livestock producers also have crops. And so if we look on the Farm Bill side of OBBBA, the commodity title, you get your increase in your reference prices, you get an ARC guarantee expansion, you get a base acre reset. So USDA is allowing the allocation of up to 30 million new base acres based on your 2019 to 2023 planting history. And if you didn't have a historical base, you can now access those ARC or PLC payments for the first time, starting with the 2026 crop year. And then the marketing assistance loan rates have increased by about 10% across the board. And so that's going to provide enhanced liquidity and a higher price floor for stored grain. And so a lot of these formulas are in much greater favor for farmers. And of course, your benchmarks for corn and soybeans have increased by anywhere from about 11% for corn up to 19% for soybeans and 15% approximately for wheat. So you've got a lot of opportunities there. In the fall of 2026, the ARC PLC payments are going to be significantly higher because of the increase in the base acres and because of the increase in the reference price. So we're moving that floor up. We're starting with a higher floor. And then we've got, in terms of risk management and crop insurance, there's been enhanced subsidy rates. You can be a beginning farmer and rancher and get kind of a double stack subsidy and for a longer period of time, up to 10 years now. And the premium subsidy for supplemental coverage option has gone up to 80%, and you can use enhanced coverage option to reach 90% coverage with higher subsidy support. So those are kind of a big deal on the crop side. So if you're a livestock producer that also has crops and maybe you're growing those to feed to your animals too, you got a lot of provisions that you can use on the commodity title that's in the OBBBA.
Another part of this is the 2026 ARC versus PLC decision matrix.
Yeah, what I've done here is put together, which program wins. Well, it's based on your scenario. And Greg, the really nice thing that was just announced in mid-January by USDA is you don't have to make your ARC PLC decision for 2026 until after your planting is done and you see where you're at. And I think they're going to probably defer this off until September. Of course, you're going to have to make the decision by the end of September. But to be able to do it after the fact and fine-tune it to your operation, that's a great opportunity for producers. And, of course, this year you get the higher of ARC or PLC. So what I'm talking about is in this year, meaning 25 crop year. But as we move into the 26 crop year, it's going to be after the fact. But basically, if you think you're in a market slump where we've got high yields and low prices, I want to go with PLC. If I've got a localized disaster, so there's high prices and low yields, then PLC is not going to pay anything there. So I want to go with ARC, probably ARC County, because you're going to get a payment. The 90% revenue guarantee was breached by the yield loss. So if it's kind of a middle ground is where I'm at, I would call this moderate price or yield dips. Let's say that prices and yields dip by 10 to 12%, then the winner there is ARC County. It'll capture what I call the shallow losses that PLC will miss entirely unless the price drops below the established floors. So look at what I say here in terms of tips for producers this year is watch your base acre bump, layer your supplemental coverage option. You can pair your ARC with the supplemental coverage option. And since your sign-up is delayed, you've got a knowledge advantage of all of this. And then make sure your farming entities are structured properly. Make sure the election is signed, whether you're going ARC or PLC, is signed by all members of an S corporation or an LLC. And now we've got a new qualified pass-through entity rule that says that each actively engaged member can qualify for an individual $155,000 payment limit, which is up from $125,000. So if I'm anything other than a C Corp going forward now, I can get as many payments as I have people in my operation that meet the active engagement test. That's a really big deal.
Roger, as we move on, getting towards the latter part of the program here, another big item contained in OBBBA are permanent tax provisions and 2026 enhancements.
Yep, just kind of reviewing what we talked about. You got bonus depreciation that's permanent. You got an enhancement to 179. You got the QBI deduction at 20% that's been made permanent. You got that estate gift tax exclusion up to $15 million. And so what producers need to do here is kind of match their tax coordination strategy with policy triggers under the commodity title. So depending on what your objective is, if you want liquidity management, you've got increased loan rates. And you can use those higher loan proceeds for operating capital and then defer grain sales or your livestock sales into a lower tax year. If you're going to reinvest in capital, you use your PLC or ARC bridge payments that are coming at the end of February. If you're trying to figure out what entity structure optimizes your payments, you want to use that qualified pass-through entity rule. And if you're doing succession planning, you got the new farmland installment sale rules under Section 1062. So you want to work both of those together, the policy and the tax provisions, to optimize your bottom line in 2026.
Also looking at integrating your commodity payments also with your tax strategies too.
Yeah, and I would throw in on that, Greg, the Supplemental Disaster Relief Program. We're looking at, mostly we're done with stage one, we're moving into stage two, and that's more manual than stage one. There are different filing nuances to be considered between stage one and stage two. And then you've got your base acre capitalization strategy. So with 30 million new acres being allocated in 2026, many farms are going to see a sudden increase in what I would call farm program wealth. So use those payments to secure financing for such things as drainage tile, irrigation improvements, structural improvements to cattle feedlots, those types of things that can be bonused. And optimize that qualified pass-through entity rule that I just talked about. And so there's a lot of opportunities there. I know we're out of time. You and I could probably go on for another hour just talking about these things, but lots of tools that can be used in 2026. People really need to lean on their tax advisors and their other financial advisors and planning advisors to help them work their way through all of these provisions.
And with some of the changes, like as an example for ARC and PLC, as you plan throughout the year with already a month in, and several deadlines to meet. There are different deadlines this year, normal deadlines, but there's some different deadlines too to remember for this year too.
Yeah, indeed there are, and we've already passed 3 of them already. The next one that's going to come up at the end of this month is the farmer bridge payments, and then of course you've got your crop insurance deadline that's coming up, and then SDRP, then your acreage reporting. I'm expecting ARC PLC sign up to be in the fall, and then you'll have your program payouts in October, and then you get your tax year in. So before you know it, Greg, we're going to be at the end of 2026. There are a lot of critical decisions that need to be made starting now by farmers and ranchers.
A lot to digest, but as you mentioned, talking with your tax advisor, most important were some of the changes this year.
That's indeed true.
All right, and people, if they're not in Nashville hearing this presentation, can they find more information through what you post as well?
Well, the entire piece together will go on my Substack, but yes, there are these pieces I talk about on my blog, but not all together in one spot. That's on my Substack.
Okay, sounds good. Roger, as always, appreciate it. Thanks, and we'll talk to you soon.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us this morning on the Ag Issues program here on 580 WIBW.